Hello, everyone. I'm your host, Eric Swartz, Web3 tycoon and head of Web3 at Sterlington. Please join me in welcoming my close friend, Yoda Regev. Please introduce yourself to the audience, bud.
Hey Eric, thanks for having me. Hey everybody. My name is Yoda. I'm originally from Israel. I relocated to the States after I sold my last company and decided that the next one I will build in the Bay Area in the Silicon Valley. This is where I'm based. I'm a serial entrepreneur. I built 5 companies, sold 3 of them. This time I decided that I don't want to build anything for selling. I want to build my legacy and my empire. And I decided to build it from the center of the world, which is the Silicon Valley. I'm into blockchain for many, many years. Started very earlier. Got scammed many times. People stole my Bitcoin more than 3 times. I remember for different times. So I kind of experience whatever else experience, which is the bad, the good, and the ugly. And most of the time that I'm thinking about solutions, they're usually coming from personal experience or personal pain that I try to solve mostly for myself. But then I find out that my pain is everybody else's pain. So I'm sharing with everybody what we're building, and all the time try to bring to the world more advanced solutions that can benefit everybody.
I know it's incredible to see, and I really appreciate you doing that and sharing that with the world to for their own use cases and for like underlying use cases that will be super interesting, especially more financialized use cases as more compliant ecosystems build out technologies like quantum finance, which quantum finance is a reimagining of the market, permitting for a new type of NFT order book whereby transacting parties are able to elect to unwind transactions in certain circumstances and thereby, in essence, fully hedge their position automatically on chain.
So basically, let's talk for a second about what's going on and why we come up with a new solution for the NFT industry. Um, I want to take you back for a second for how the industry started, not as an NFT, but as a crypto, right? Back then, in the early 2016, 17, when people start to invest in cryptocurrency, utilizing ICOs models, there was no liquidity in the industry. People basically bought into tokens, and on paper, they made a lot of money, but they didn't have any exit strategy because there was no many exchanges available back then. And those that was good, like Kraken or Coinbase, didn't pick up any project that just went live, right? So a lot of projects made money on paper, and investor had to see how the money going under when the market become to be bear. Now, in 2019, Uniswap introduced automated market making, which is basically instead of do peer-to-peer that people sell to each other, for the first time ever, you've been able to do peer-to-contract, which means you can basically sell your token to a smart contract and not for a counterparty, which means you've been able to engage with liquidity even without listing on Coinbase. And for the first time since then, which is the early of 2019, a lot of projects been able to engage their investor with liquidity instantly by listing on decentralized exchanges, right? And that really opened the door to a new type of industry. All the DeFi industry, decentralized financial industry, basically based on the AMM protocol. You cannot do insurance without it. You cannot do short to long term hedging without it. You cannot do option without it, or leverage without it. Even flash loans or lending protocols. It's everything been built on top of those protocols, which is peer-to-contract. So in other words, we can say that the peer-to-contract brought into the crypto industry a new dimension or a new solution that haven't been there before. Now, if you're looking on the NFT though, it's kind of have the same history. The NFT in the last bull run done tens of billions of dollar daily trading, but it all was based on peer-to-peer, which means if you go to OpenSea and you buy some NFT from somebody, you can only engage with exit strategy with your money once you will sell it to the next buyer, which means you need a counterparty to sell it to. And if there is no counterparty, basically you have absolute loss, right? It's like a zero-sum game. So you can say that right now the NFT industry do not have liquidity. If you're buying something, there's no liquidity. You cannot go to smart contract and sell it too. You have to wait until you will have a buyer. And that limiting that industry, that basically do not open the door for the industry to scale like the DeFi done to the crypto. So what we have created is a new type of protocol called DNFi, which is designed to do to the NFT what Uniswap did to the crypto. So instead of having peer-to-peer exchanges for NFT, imagine to yourself that you have peer-to-contract, that you have a new type of technology that allow you to engage with liquidity even if there is no counterparty. Imagine yourself that this protocol can allow you to borrow against any NFT instantly, even if it's a no blue chip monkey, right? Imagine yourself that you can even borrow 100% and not 50% LTV. Imagine yourself that you can do leverage on NFTs. So all those instruments that until today was limited to crypto, now for the first time will be able to be available for the NFT industry. And it's very important because a lot of people do not understand that NFT is more important than crypto, because NFT represent not just art, you're representing value. It could be a car, it could be a home, could be different type of items that basically tokenized by an NFT. So NFT can be a real world asset, but without liquidity, you cannot have trading industry. You cannot have basically volume coming in or interest coming in. So it will limit the industry without it. And this is what we have developed. We developed a solution that allowed it. Now, how the solution works, it's basically instead of having the project like in AMM, if you remember when project with crypto want to do ICOs or IDOs or any type of initial offering, they usually took some of the money or sometimes even the entire money and they lock it in the smart contract. You can call it as a refund policy. They basically say to the user, hey, buy the token, I will put the money in the smart contract, and any time that you cannot sell it to the next buyer, you can return it to the smart contract and you will get a refund. That's what basically AMM is. It's kind of turning the company, the project, to be a market maker. So the project buying back those tokens by providing proceeds that they receive from the first place. Now, there is a guarantee when you're buying a token that you can get a refund if you will send it back to the smart contract, but there is no guarantee how much you will get. You don't know if you get more than what you pay. Maybe you'll get by far less than what you pay because it's fluctuated, right? The liquidity and the value in the token in pools is fluctuating. So you don't know for sure how much you'll get, but you know for sure that if you send your token to the smart contract, you'll get something in return. Now, in the NFT industry, we didn't use the same method. We didn't turn the project to be a market maker. We didn't say, hey, conduct an IDO and then use the proceed as a pool concept. What we did instead is using the sellers, each individual seller is basically become to be a market maker. So what that means is that if somebody buying from you an NFT, instead of OpenSea version that you pay him and that's it. He took your money, you took the NFT, it's a done deal, there is no returns, there is no liquidity. If you make a good decision, bad decision, nobody know. Here in the new protocol, basically the seller can ground you some period of time of protection. It can say to you, you know what, I'm selling you my NFT for $1,000, but I will not touch the money. The $1,000 will stay in the smart contract protected for, let's say, 1 year or 2 years or 30 days or 90 days. So the seller can decide how long protection it will ground you. And then if you never return the NFT and get your money back, so that means it's a final deal, right? But if during that protection time you return the NFT in order to get your money back, basically the seller will be eligible to get the market maker fees, like a slippage. So in other words, the way that the quantum finance model work in the NFT industry is that each seller is basically holding two positions. In one side is a seller, but on the other side, he acting as a market maker. Which one is going to be, it's not clear at the moment, because if somebody grant you 1 year, for example, of protection to get your money back, we don't know for sure if the seller will benefit as a market maker from slippage once you will return the NFT and get your money back, or it will become to be a final seller and it will be generate basically the profit from selling it. But it will guarantee to himself that he will have one of those two, right? On the other side, as a buyer, you're not really a buyer. You're a buyer, not a buyer simultaneously. You can buy an NFT, sit on it, try to flip it, and if the market goes south, you can change your mind and get your money back minus the market making fees, minus the slippage that you need to pay for the seller. So theoretically, as a buyer, you can see the future first and make decision later. You can change your mind. So it kind of, again, give you quantum position that you can hold two positions as a buyer and not as a buyer simultaneously, see if you made the right decision or not before you finalizing your deal. So basically, by creating a quantum finance model that allow the seller to ground to the buyer protection during the selling, it's not only bringing liquidity and reducing risk to the buyer and increasing fees and income stream to the seller, it also complies with the most of the countries in the world, because NFTs, they are not a security, they are a product. And in the most countries, including United States and Europe and many even Asia's countries, when you're buying a product from a distance, you have to ground the buyer 14 days cancellation time frame, no question asked. And if you do not do that, the buyer have a claim against you that you break the law. So theoretically, every time somebody go to OpenSea and buying an NFT from some protocol like Yacht Club and all those sellers, basically because OpenSea do not comply with the law 14 days, they not only do not protecting the buyers and the seller, but also exposing themselves to class action lawsuit when it will go south. So the new protocol that we created basically not only comply with regulation, but it's also reducing risk and increasing income stream for the all parties that involved in that, and putting for the first time the ground for financial instrument for NFTs, something that never been done before.
And what I think is like equally appealing is just like essentially like a third party could also come into the ecosystem and provide insurance and reinsurance to then have parties able to transact without one needing to be in that position. And that could be like super interesting as well. Like is that something that's in the roadmap or something you guys are thinking about, or is that not necessary for some reason?
So basically, the new protocol that we created have a lot of moving parts. Some of them are insurance, some of them are levers, some of them are basically options, some of them lending protocols. So we kind of created a new type of foundation or infrastructure for DNFI, right? Decentralized NFT finance solutions. So if somebody is a seller, it doesn't matter who he is. It doesn't matter if he's an issuer or a buyer. But the moment that you become to be a seller, you can basically hold a position that will grant your buyers a protection. So your buyer will be protected. And it doesn't matter if it's a bull run or it's a bear market, people will be protected when they're buying those type of products. And that will bring much more confidence for people to engage with those products when they know they are protected. On the other hand, the sellers that providing this protection, right, will be able to have better conversion rate. They will sell more, they will gain more. Even if there is a cancellation, they will basically gain from the cancellation because they will get slippage every time someone canceling. And everything that we build is kind of a multi-layer, which means if you're buying something from someone under protection, even though it's under protection, you can still go ahead and sell it to the next buyer under protection still. So basically, people can flip those assets forward and keep scaling that, knowing that everybody that took part of that flipping chain is protected. And by doing it like that, it basically can increase the volume to the industry. It can welcome any player. You don't need to be a blue chip. It's no longer limited to the best sellers or the best influencer. It's kind of opened the door for any player or seller or issuer or artist to play ball, because nobody will judge you if you're a first-time seller and nobody know your name before, because you're providing protection to your buyer. So there is no really a risk from buying from you and then change their mind. So everybody will be in position to give you a chance to see if your product or your NFTs will make it or not. Versus today that people are afraid to buy from unknown sellers or first-time issuers or collection that never had any track record before. So it's really a game-changing when it comes to the NFT. And also, I don't know if you follow the news regarding to not licensing, a royalty. Creators that creating royalty facing issue to force their royalty because protocols like OpenSea cannot force it anymore because there is some tools that can work around it. So imagine yourself that you create an asset and you're willing to sell it under condition that for perpetuity you want to get a royalty, and then somebody somehow hack and sell it without you get benefit from that in the future. It's hurting you as a creator. It's like stealing, right? So our technology is different. It's not a royalty. It's a multi-level ownership, which means nobody can work around it. It's impossible to hack it. And it's basically not only granting to the creator a royalty, it's basically creating a layer of royalty for every seller. So imagine to yourself that you're a buyer and you bought something that have a royalty to the creator, but you decided that every time that something will continue to sell forward from you forward, you also want a royalty for yourself. So you can add yourself to the royalty, and from now on, every time it will be continued to flip forward, you as a buyer that just bought it maybe for 1 second and sold it forward. For perpetuity, you will be enjoying from having a piece from future income. So that can bring a lot of buy pressure for people to want to own something and flip it forward in order to maintain that position. And like I said, unlike OpenSea that is not forceable or it's hackable, in our case, the way that we design this protocol, you can not hack or go around it. There is a guarantee that if there is a royalty for the creator and for the buyers that been added down the road, all of them will get the piece and the share once the asset will continue to be sold forward. So like I said, right now, the NFT industry get it wrong. Nobody buying a monkey for $100,000 because they like the picture. Everybody buying those products because they believe that it may worth more if they will flip it forward. So in other words, it's a vehicle, investment vehicle, right? in that way or another. It's like you're buying an art. Why are you buying a Picasso? Most of the time you're buying art because you want to hold it and then flip it and make basically money from flipping it forward. So when people buying those special product that have some value and they're hoping to flip it, the current industry do not provide right now the right tools for that. OpenSea acting like it was a product selling on gallery, like it was eBay. This industry is not product on eBay. This industry is very sophisticated industry with a lot of moving part and financial stuff around it, but there is no yet infrastructure and tools to provide to the buyers and sellers to act in that industry like it's supposed to. So this is what we build. We build a new type of instrument, new type of protocol that's turning the NFT industry into exponential industry and not as product on eBay, right?
Incredible, incredible. I'm super excited for everything that Quantum's doing, and I think it's really important that everyone kind of is, zoom on in and understand that like without that type of liquidity, the markets are really not likely to come back. There's never going to be a solid forced liquidity like that without preconditioning it. So, and the insurance aspects of it are super interesting, right? Because there's a lot of people that might find just the insurance like economics that you describe interesting, which I think is another a cool angle that the protocol can certainly leverage. And I think just any kind of infrastructure project right now is so exciting to see, whether it's in NFTs, Web3, or AI, because we just need to have more building and proliferation to really see those products come to market and be really, really interesting and fully developed. So I'm psyched to see everything that Quantum has to offer, and I can't wait to participate in the fair launch as a member of the community.
So actually, we
Um,
do something very cool regarding to the launch. We didn't want to do kind of a public sale that people buying the tokens, right? Obviously, not just because it's a security issue, but also it's not really working well, as you can see in many other projects, because people become to be a dumper and stuff like that. So we took a new approach. We basically created a new type of AI-based NFTs that when you bind those NFTs, two stuff happening. Number one, you can influence the pictures. You can say prompt to the prompt how you want the picture to be changed. And basically every buyer that buying it changes the picture. So it becomes to be a movie of from where it started versus where it's ending, right? Like a movie of changes. So every person that buying it can change the picture, adding, removing stuff from the picture, and the AI will change the picture for you. And then every time it's changing, a new type of airdrop being attached to the NFT. So theoretically, imagine yourself that you're buying an NFT and it's coming with between 0 to, let's say, 1 million NFT tokens, right? That belong to the protocol as an airdrop. Now, how many tokens airdrop you're going to be eligible for, you don't know. So every time somebody buying it, it's randomly choosing the amount of the airdrop. So let's say you bought the NFT and you spend $1,000, but then the value of the NFT and the airdrop that it's coming with worth, let's say, $10,000. So you basically made 10x right on the spot, right? You may cash out the NFT, destroy it, and cash out the airdrop tokens that behind it. Or imagine to yourself that you spend $1,000, but the value of the NFT become to be 500 and there is no much airdrop token behind it. So you feel like, oh, I spent 1,000, but I got value that is less than 1,000. So in that case, you have the cancellation period of time protection. So you can cancel and get your money back. So there is no really risk here for you to buy into those special AI-based public sale NFTs that we're creating, because it's allow you to play a game and maybe gaining from the game, but there is no downside for that because of all those protection layers. And it's also fascinating because you don't know how much airdrop your NFT will be eligible for. For every time you're moving it from wallet A to wallet B as a sale, it's raffling a new amount of airdrop that the NFT will be eligible for. And theoretically, you can do even 100x by investing, and then suddenly the NFT worth more plus the airdrop that is eligible for. So whoever going to buy those AI-based NFTs not only going to enjoy from unique NFT picture that changing from one user to another, and you have ability to influence how it's going to look like, and the value will be very priceless. It's also going to ground you an airdrop value that you do not yet know what it's going to be, but it can definitely be very high amount.
That's incredible, and I think the structuring sounds very in line with what I think a much safer NFT retail market would look like. So I think it's a good direction to move in, and I think it's a lot um, closer to something that the regulators could find is appropriate without some real like remediation, essentially like change of the business essentially is what I mean when I say remediation, by the way. And and I think that's really, really forward looking, and I think that's really thoughtful. And I know the team at Qwantum is really plugged into the legal ecosystem, and the approach has really been informed by that. So I I applaud your guys' efforts in those regards for sure. And I guess one since we're changing gears here, another project you're working on, CBDCs. Um, I think they're a war on freedom. Naturally, I'm a little anti CBDC, therefore, but love to hear your perspective on it, and what you think the rails will be used for.
So um, I want to be clear something about our organization that we did and talked about it when we started. Our organization called Quantum Finance Labs. And the reason that we called like that is because when we're developing solutions, we're utilizing a new approach that's called quantum finance, which is kind of allow the development to create multiplied positions simultaneously or dealing with multiplied position issues. So when you're looking on the CBDC, it's clear that the countries will go into that direction because they need to control the money and they need to have a record where the money moves because of obvious reasons like anti-money laundering. But there is a risk that I think they do not even aware of that risk yet. And the risk is that until today, when money being created and it been valued, meaning trading, it used to be traded by high level of institutional. So institutional buying money, selling money, and the value of money around the world is facing by those that buying and selling. And also there is the Fed and other bureaus around the world that involved tightly influencing the value and maintaining the ratio as they want it to be. Now, once CBDC will be created, basically what will happen is that the game or the rank, let's call it the court, where the marketplace, when stuff being detriment until today, will move from institutional to the street. So instead of Wall Street, it becomes to be Main Street. So people will basically have the ability to sell and buy from each other CBDC or different currencies, and they can change the value, and that can take out of control the Fed from the picture. So I want to be clear that the moment that you democratize money and you give to users, the end users, the ability to trade on secondary markets between themselves, those assets, um, they can change the value. And by doing it, you cannot be centralized anymore. So the willing of the government is to stay centralized and control it, but basically they will lose the control over that because they democratize it. And I will give you an example of how value can be changed easily. Imagine to yourself that investing in crypto, or let's say investing in Bitcoin, will become to be easy as a click of a button. Every phone or simple app will show to you, even ATM, when you go in the street, will show to you a button and say, if you click here, you're buying or selling Bitcoin, okay? I'm using Bitcoin because it's easy to imagine that happening before altcoin, right? Because it's more decentralized and more acceptable. Now, what that means? That means that when Bitcoin will go high and people sitting on stablecoin like CBDC, they will not be worried to sell the CBDC instead of dollar for 99, 95, 97, 92 cents on the dollar because they try to jump on a trend when it's booming. On the other side, when Bitcoin will go down, and as you know, it's always going up and down, it's the cycle life. Investors, which is the crowd, don't mind, right, to buy into stablecoin instead of dollar, $1, $2, $5, $10, just to avoid a loss, a big loss of the Bitcoin. So basically what he's telling you is that a lot of individuals can buy billions of dollars with few percentage above the tranche or few percentage below it. And they can basically change the value in the world of the currency. Now, if a country wake up tomorrow morning, the US government wake up tomorrow morning, and suddenly the dollar worth 5% more than yesterday, or it's worth 5% less than yesterday, that's not a small thing. That can actually take under the water some businesses. If you shave from Walmart 2, 3, 4% of the value, there is no Walmart anymore, right? 2, 3% of the value of the sales, if it decreased, the entire net become to be negative. So some country that's lending money to the United States or borrowing money from the United States can go under if suddenly the dollar worth 5% more than yesterday. So basically, by creating CBDC and give it to the users, and they will be able to trade that on secondary market exchanges, you also basically not only democratize the money, but you also decentralize that without notice. So I want you to look on something interesting. Government want to maintain centralized position, but by creating CBDC, they are decentralizing and democratizing that position. So you need to ask yourself a question, how it's possible to have a CBDC that stays centralized and decentralized on the same time? That's called quantum. How can you have both? The current CBDC that being created do not have both positions. Right now, they have basically willing to have centralized, but they will become to be decentralized without even controlling that. And that can lead to very big no-no. But the end game of the government, they want to have centralized position, but they also want to democratize, which means it become to be decentralized. So you need to think, what kind of technology can have both centralized and decentralized simultaneously? And that's what we are building. We have a lot of projects that are based on quantum finance model. One of them designed to be a layer on top of CBDC to guarantee that they will be able to maintain those two positions and reducing the risk that I mentioned.
Incredible, man. And I know a lot about that kind of risk as well. And I think that's really, really exciting for like the Forex markets just generally, and a good bridge for the divide between the traditional Forex markets and what is known as like the DeFi Forex markets currently today is this type of technology and essentially a backstop for the counterparties, because institutions aren't going to be able to participate if you don't have this sort of backstop, as Yoda described it so technologically artfully. Um, and in that code, without that backstop, it's really, really difficult for me to get excited about a CBDC and we need some sort of reference to a fixed value typically would make things a lot better, like back when gold was linked to the dollar or something of that nature. But and it could be Bitcoin. I think RFK's proposal is a really, really interesting one. It's one that I've always thought that the government should do or consider. I mean, all governments should do and consider. So we'll see. We'll see where it goes. I'm certainly hopeful for his election um, results to be positive and hopeful for him to like really secure the office because at the end of the day, with Bitcoin as the backing of the US dollar and Bitcoin as um, a tax um, a tax minimized asset, incentivizing the mining industry here in the US, which has already kind of flourished given our affordable energy rates in certain states within the US, including in particular Texas. So yeah, I think what I would love to get to next though, and honestly, we are just talking about two startups that Yoda has created, but his series of startups prior to these is 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 extremely um exciting and really like an operator's um top performing operators go-to guide to really learn how to be a software company founder and how to exit those businesses successfully and and have positive returns for investors and for yourself. So there's a lot of fear about speed of deployment of technology into production, even without standard smart contract audits obtained, because the space is just moving so fast. Do you think there's anything to fear about that?
So I think entrepreneurs that building stuff should run after the next whatever buzzword is, because until they will finish to build something, which usually take 6 to 12 months, assuming that you not copycat somebody else's work and steal his code. So by deploying something new or developing something new, it will take time. And by time when you will be ready, the industry already moved to the next big thing. So I will say that if you really want to play ball with the industry, you need to do two stuff. Number one, you need to solve problem in unique way. So even if nobody know what it is yet, nobody doing it yet, nobody ever heard about that type of direction that you're taking, you can be the pioneer to try it out. So for example, quantum finance model that we're using is very new. Most of people don't even know what it is. It's extremely new that there is very few experts in the world that actually know at the moment how to build quantum finance solutions. But I believe that in a few years, everybody will talk about quantum finance as the right method to operate and build stuff around. And it's also solving our problem in the very elegant way like we want it to be solved. So by embracing new type of approach, we're taking a risk. Now, is that risk going to pay off? Most likely not. 98% of all startup fails, and we are not a magician. We don't have superpowers to change the statistics. So by building stuff, you need to take under consideration that most likely it's going to fail. But you're building it because it's the right solution to the right problem. And if you build it earlier, even though there is no ground yet for that, maybe when the industry will shift, the wave will be created and it will carry you on. So you're not chasing after wave. You're waiting for the wave to carry you. And if you build the right thing and the industry shift to the right direction and everything being in the right place, the moon, the sun, and your energy and whatever luck you want to put together in that blender, maybe it will work. But you need to understand that most of the startup and project that been built, they're losing money, they're going under. Whoever investing in them do not see any positive outcome, and that's life. Not everything is pink like you see. All the Cinderella stories that you're hearing about, they're very aware of people invest in Ethereum when it just launched, or Bitcoin when it just created, or Uniswap when it just brought into there. So those are stories covering a lot of sad stories and a lot of missed opportunities. So eventually we're building stuff not because we try to make a buck. We're building stuff because we believe that there is an issue, and we believe that those solutions solving the issue. And we hope that everybody will enjoy from that, but there is no guarantee that none of those stuff going to be a home run winner, right? But we keep building. That's what we do.
Thank you for that. We appreciate it. And we need builders like you in the ecosystem to really iterate on the types of financial models possible using smart contracts and find the right types of products to deploy into the space and really actively utilize. Thank you so much for coming on, Yoda. Web3. We hope you'll join us next week to continue our journey unraveling the mysteries and exploring the limitless possibilities of the new internet.